In mandating minimum price tick sizes, market operators must strike an appropriate balance between liquidity, transactions cost, and effective price discovery. While narrower tick sizes can provide for reduced transactions costs and allow more exact price discovery, it also has the potential to reduce liquidity by fragmenting depth across multiple price steps. It is this tension that has led to the SEC to propose a trial for larger tick sizes for smaller firms. The experience of narrower tick sizes in Tokyo can provide some preliminary evidence on what may be in store for the US. In an attempt to improve market quality and encourage trading, the operators of the Tokyo Stock Exchange recently narrowed the tick sizes for stocks that make up the TOPIX 100 index. This index consists of the 100 largest domestic Japanese companies by market capitalization, and therefore are highly liquid. This high level of liquidity should insulate these stocks against any negative aspects of narrowing tick sizes, resulting in only improved transactions cost and price improvement. Implemented in two separate phases on January 14 and July 22, 2014, the TSE reduced tick sizes to either 1/2 or 1/10 of their previous size. For example, the bulk of TOPIX 100 companies trade between 1,000 and 3,000 yen. Tick sizes for these securities dropped from 1 yen to ½ yen. Tick sizes for stocks in the 5,000 to 10,000 yen bucket were reduced from 10 yen to 1 yen. Using the market quality dashboard, we analysed the impact of this tick size narrowing on trading stocks in the TOPIX 100 stocks. To analyse these changes, we have previously constructed a group corresponding to securities in the TOPIX 100, which we can access by selecting the Groups tab. We then select the time period, including both dates of the change, in this case from November 2013 to August 2014. Choosing first the quoted spread measure, we can immediately see two drops in the quoted spread that correspond with the two phases of the change. We also expect this to be reflected in the effective spread measure, which we can use as a proxy for transactions costs. Switching to this metric, we can also add in trading on the TSE as a whole, comparing TOPIX 100 with the entire marketplace. Here we see sizable drops in effective spread for TOPIX 100 stocks, suggesting a significant decrease in transactions costs. As TOPIX 100 is a large part of the whole Tokyo Stock Exchange, we also see a drop in effective spreads for the market as a whole. The TSE also expected the narrowing of tick sizes to bring about price improvement. Changing to the price impact metric, we again see significant drops in the TOPIX 100 securities that correspond with the dates of the change. Unlike effective spread metric, we see little change in TSE as a whole, likely as a result of the higher price impact experienced in less liquid securities. The improvements in these two metrics indicate that the reduction in TOPIX tick sizes has met the TSE's expectation of improved investor experience. However, we should also examine for the potential negative effects of reduced tick size. To do so, we switch to the on-market trade volume and trade size metrics, where any reduction of liquidity may be reflected in reductions by the size of both individual trades and trading over each day. Here, we see that while the increased granularity has reduced the average on-market trade size for TOPIX 100 stocks, the daily trading volume remains largely unaffected. The smaller trade size is indicative of liquidity which was previously posted at one tick size being spread out across multiple price steps, resulting in smaller individual trades. With decreased transactions cost, improved price discovery and no negative impact on trading behaviour, it would appear that overall the reduction in tick size for TOPIX 100 securities has been beneficial for the efficiency of the Tokyo Stock Exchange.